Accounting Standard 12, Government Grants or Accounting for Government Grants. So in this section, we'll take a look at the different types of government grants, grants to non-depreciable assets, grants related to revenue, grants received in compensation, grants in nature of promoters' contribution, and grants that are refundable. So first off, we'll start with government grants or types of government grants. So what is government grants? Government grants are assistance extended to by the government in the form of cash or kind to enterprises in return for future or past compliance under certain given conditions. What cannot be valued reasonably is excluded from government grants. What cannot be considered government grants are those transactions with government which cannot be distinguished from normal trading transaction of an enterprise. Hope this is clear. Now, government grants are also called subsidies and does not deal with government assistance other than government grants. Any form of government participation, that is, other than government grants, any form of government participation in the ownership of the enterprise or equity investments done by the government. Now, the government grants can be of two types. One is monetary and the other one is non-monetary. Monetary grants relate to depreciable assets, and non-monetary grants in the form of land, plant and machinery is grant given at a concessional rate, or if the grant is given free of cost, such grants then get recorded at a nominal value. Now let us take a look at what is government grants when it is relating to non-depreciable assets. We know what is depreciable assets. Fixed assets are depreciable assets. Machinery is depreciable, but what is non-depreciable assets and what happens when the grants are given to non-depreciable assets? When grants are applied to non-depreciable assets, it is deducted from gross value of asset in arriving at its book value. When grants are availed with which equals the cost of assets, the assets should be shown at nominal value in the balance sheet. That is, if the entire cost is given, the assets are shown at nominal value only in the balance sheet. If conditions are attached to grants and it is fulfilled, those conditions or those grants are credited to capital reserve account. So if there are some conditions which is existing for a particular government grant, maybe purchasing of a motor for irrigational purposes, if something like that, if there is a government grant which is there for that purchase, and if that grant is giving the entire cost, then it is only recorded in the nominal value. But if conditions are attached, let us say if there is a condition which is given that within some 6 months, a portion of the grant has to be refunded or to be paid back. So if some conditions like that exist, then those grants are credited to capital reserve account. If it is yet to be fulfilled, it is credited to income statement until the cost of meeting such condition is charged to income. Next, so that is about non-depreciable assets. Next, we'll take a look at grants which relate to revenue. If grants relate to revenue, it is recognized in profit and loss account over the period in which related costs are matched, over which it is intended to compensate. So that is grants which relate to revenue. If it is in compensation, if grants are received in compensation or granting financial support, such grants are recognized in profit and loss account for the period in which it becomes receivable as an extraordinary item. For promoters' contribution, if there are grants given in the nature of promoters' contribution, it should be credited to capital reserve and should definitely be part of shareholders' funds. So that is if it is in the nature of promoters' contribution. If the grant becomes refundable, amount of refund should be adjusted against unamortized deferred government grants, and the remaining balance should be charged to profit and loss account as an extraordinary item. So this completes accounting for government grants. Thank you.